Welcome to today's webinar. Starting the webinar on Introduction to Financial Planning. Now, this is a very important module because this takes you through the process of how to go about in terms of financial planning, the basics of financial planning, what is the nature and scope of financial planning, what are the do's and don'ts of financial planning, and what other aspects which are important in establishing the background of financial planning, right? So we'll be covering a lot of topics right on from in terms of client-panel relationships, then in terms of time value of money, in terms of legal processes, legal aspects, in terms of how to analyze financial statements, the cash flow statement, in terms of how to take title to property, in terms of macroeconomic environment, in terms of asset management, and in terms of how to deal with your financial advisor in terms of the requirements from both sides, both the client as well as the planner, the various forms that you need to do, the various aspects that you need to do or need to consider while preparing a financial plan for your client, and what are the important things that one must incorporate in a financial plan. So these are some of the aspects which actually give you a background and base to the entire process of financial planning. And this happens to be the first module of CFP. Though the examination, it is not, there is no examination for this, but nevertheless for the other modules, it definitely gives an introduction, and therefore it is very, very important to go through this module and understand the various aspects, including the conceptual knowledge that is given through this module, because a lot of matter, a lot of subject that is covered in this particular module can be easily incorporated and used in the other modules as well, especially for example time value of money, in terms of making a budget, net worth statement, financial statement analysis, and these are some of the topics that are very important, which are used in other modules as well, right? Now, in terms of introduction to financial planning, now, the very important thing to understand is that when you actually look at financial planning, what is it that you actually mean by financial planning? Financial planning is simply the process of meeting your life goals through the proper management of your finances. Now, each one of us has a different set of goals. For example, some of the common goals that all of us would have, for example, could be in terms of buying a house, buying a new car, providing for your children's education, planning for retirement, hoping that you will have a good lifestyle, and so on. So these are some of the goals that we have, but many times, we are not able to prioritize them, and we do not know how to, structure those goals and provide for them in the best possible manner, because we simply cannot divide our finances in terms of, meeting all these goals. Now, some of the investment avenues that are there for financial planning include common stocks, bonds, mutual funds, insurance, annuities, real estate, gold, art and antiques, and so on. There are various products that are there, and each of the products have different risk return characteristics, as well as they can be again broken up into subparts. For example, if I take a category like bonds, right, they can be government bonds, they can be private sector bonds, they can be credit rated bonds, and they could be below investment grade bonds. Similarly, for mutual funds, I can have equity-related mutual funds, I can have debt-related mutual funds, I can have balanced funds, I can have sectoral funds, I can have thematic funds, and so on. When I take insurance, then again insurance, I may have whole life insurance, I may have term life insurance, I may have ULIPs, right? I may have endowment plans, and so on. And each of them have their own advantages and give different measures of cover for the client. Then there is also in terms of general insurance. In general insurance, we are covering health insurance, which is a very, very important category that we need to take into account. And there are various types of plans for different individuals, including even one that is meant for senior citizens as well, because that's an important category. Again, you need to figure out how much insurance you need for life insurance. Other general insurance needs would cover in terms of household, baggage, travel, liability insurance, and so on, right? Disability insurance is yet another category which needs to be covered, that in case you are temporarily incapacitated, then or permanently incapacitated, and what is the amount of insurance cover that you need. There are some products that are also coming in terms of insurance. One very important category is now, for example, insurance in terms of loans. For example, a home loan insurance. Then there is something in terms of pensions. Now pensions again have various categories of annuities that you can have. You can have fixed annuity, you can have variable annuity, you can have a joint annuity, you can have a with payment of the original amount of money, or the ones that you have which do not involve payment of final money. Right? They may be for a fixed time, they may be for a whole life. So there are various options in terms of annuity which can meet your retirement needs. Then real estate was only meant in terms of buying a house and investing in it for your own needs, but today real estate also presents a whole lot of opportunities. This could include something like real estate investment trust, and we also have a product which is in terms of reverse mortgages, that is for senior citizens. Similarly, gold also. Gold, you have something like gold funds and gold bonds. Art and antiques is another very important category that is there. So with all these investment products, one needs to understand that what kind of avenues should be there for your client. There are of course some products which are there for the short term, which could be savings, certificates of deposits, etc., etc. So these are some of the other products that one needs to know about, and which the planner needs to educate his client as well. Okay. Now, the question that comes is that why do you need a financial planner? Okay. Why does anybody need to go to a financial planner, and why is it that each client has to have a separate plan? Right? If a set of individuals, if for example if they have both, let's say, have a similar economic background, have the same salary level, is it possible that their financial needs will differ? Yes, they will differ, simply because their attitudes, their goals, their objectives will differ, right? And they may have different family circumstances and different family needs. So depending on their priority of goals, right, they need to accumulate money for the attainment of those goals, which will obviously be at different points of time. Then you need to have some sort of a protection for something like, if you have death, right, unexpected death, disability, you may have unemployment, you may, as I said, mentioning about general insurance, you may have to provide for some insurance covers for your house, for burglary, for fire, etc. And with all these respect to all these goals, there is a different priority that you may need to attach to the employment of these goals, because I may have many goals, but all of them are not attainable. Some goals are more important, and therefore I need to focus on those goals, and therefore I have to attach priority to which goal that I would like to accomplish, and therefore direct my investments towards that. Secondly, in terms of even attaining those objectives, right, you can use different financial products. For example, for meeting my retirement, I can use tax saving bonds also, I can use annuities also, I can invest in mutual funds also. So depending on how comfortable I am with the investment, right, I can use a mixture of financial products to attain the same goal, depending on, of course, my behavioral characteristics, my risk return profile, etc. and so on. Now, in this case, because of the fact that you have various goals, there are different complexities, the attainment is at different points of time, you have various options and alternatives to choose from in terms of meeting those objectives. Now, where does a financial planner come? Okay. Now, as a client, right, as an individual, if you try and meet those objectives on your own, sometimes it becomes difficult, because you are concerned with basically earning money and providing for your family, and sometimes as an individual it becomes extremely difficult to find a time to actually try and figure out all your goals and objectives and try to make some sense of them. Secondly, you may not even have the necessary knowledge of what needs to be done and how to attain those objectives. So in that case, a financial planner is a practicing professional who understands it, who has the necessary knowledge and competence to it, who can actually take a very objective view of your financial situation, right? Who is conversant with the latest laws, regulations, with the various financial products, right? Who can take a view of the markets and how they are going to perform, who can tell you about how these financial products have performed in the earlier period, right? And possibly can do the necessary calculations in terms of how much money you would need for your various objectives, for example, retirement, child's marriage, etc., etc., etc. So, the financial planner is actually a professional who is full time into the job of managing your finances, right? For example, if I were to, go and fight my own case in the court, it is difficult because I am not conversant with it, right? So it's like you have a lawyer to deal with your court cases, right? A financial planner is one who would deal with your financial requirements, right? Because obviously in today's day and time, nobody has the time, right, to deal with so many aspects and especially with so many products that are available. So the financial planner is into it whole time, and like any other professional, like a lawyer or a doctor, right, he is a professional in the same mold. Right? Now, what kinds of financial planners are there in the market? Now, suppose you would go to, let's say there are various types of financial planners. You can go to a bank, right? You can go to specific investment boutiques, or you can go to a typical insurance kind of an advisor who is operating simply by himself. That is one type of a structure that you have, right? Now, what here I am talking about is not just simply act of selling a particular product. Right? What we are discussing here, when I say a financial planner, is not just a product that you want a particular product and he sells it to you or he markets a particular product. Here, when I talk about a financial advisor or a financial planner, is a person who takes into account all your needs and requirements, all your goals and objectives, and tries to figure out the best possible means and products by how you are going to attain it. So he is going to do a calculation of virtually all aspects of your needs, including insurance, retirement planning, etc., etc., estate planning. Right? Now, in that case, in the market, you will find three kinds of planners. Right? Now, one is a commission-based financial planner. Now, he does not charge you any fees, right? But he will suggest you some products. Now, in case if you buy a particular financial product, now he will take the commission from the provider. For example, let's say you buy a particular insurance policy of, let's say, HDFC life insurance. So, the brokerage, he will take a commission in terms of the brokerage that he earns for selling that product to you, right? So, he gets his income entirely from the commission. You, as a client, do not have to pay anything to the planner. Now, as a system, it is very good because the client does not have to pay anything. But from the client's point of view, one also needs to understand that in this case, you are exposing yourself to a conflict of interest. Because anything that generates commission for them and anything that generates more commission for them, right, the planner is probably likely to sell you that product more rather than any other product which may generate less commission for them, because he is earning his income primarily from that. Now, whether or not you need that financial product or not is debatable, right? Because he needs the money, he is getting that income from that commission. So in that case, anything that generates income from it, whether or not it is the best possible product to meet your life goals, it may not happen, and there is definitely some room for conflict of interest there. There is a second category which is both a fee and a commission planner. Now, a fee in terms of it can be either for a complete plan or it could be in terms of specific things. For example, you may say that, okay, I want to plan for my retirement, or let's say that I want to create a particular trust, right? Or what is the tax implication of, let's say, employee stock option, right? Or if I invest in mutual funds, right, please calculate the rate of return that I would earn, or enter me into make a portfolio of mutual funds for me, right? Select a particular fund. So it may be for a specific type of a product or a service, or for making an entire financial plan. Now, in this case, whatever product or whatever service that they will charge from that. But in case they, in the process, you are buying some products through their services or through their good offices, then they would also earn some commission from, again, the provider of that service. For example, it could be insurance company, or it could be a mutual fund, or whoever in that respect, right? But here in this case, the conflict of interest is less because they are getting their income both from you as well as the provider of the service or the marketer of the service. So in this case, because he is taking a fee from you, there is less possibility that he would harm your interest, because if you give him some fee today, he will obviously not like to do something which will spoil the relationship of you and the planner, right? So in that case, the probability is less. It's probably good as a model for those clients which are small and who cannot afford to pay huge amounts of money, right? So their investment assets are less. So it suits both the planner as well as the client, because from the client's point of view, he is getting relatively unbiased advice and he doesn't have to pay much. From the point of view of the planner, he is getting sources of income from both sides. So the need to have some conflict of interest. He doesn't also need to indulge in commission brokering. So from his point of view, he also maintains some amount of discretion. Then there is a third category which is only fee-only planners, which in a fee-only planner is that they will charge a flat rate on the basis of whatever investment assets that you have. For example, they may say that if you have a, let's say, 5 lakh portfolio, you say 1 to 2% of your portfolio, they will charge a fee which is a percentage of the investment portfolio. They do not take any commission either from whoever is providing any financial product. They are not reimbursed by companies. The advantage is that you get completely unbiased financial advice, because their only source of income is from you, right? And therefore their entire loyalty is to you. They may arrange to whatever your plan implemented, right? But as a matter of thing, they themselves do not enter into that, and they don't earn any commission. The flip side of it is that because their fee is based on a percentage of investment portfolio, and they would only entertain those clients which have huge net worths, which means that this kind of a service is available for only those clients which have huge portfolios, and possibly for the retail investor, it is this kind of service possibly only the high net individuals or the ultra high net individuals would be able to avail of, right? So this is in terms of what kind of financial planners are there, right? In terms of scope of financial planning, as earlier mentioned, right, one is of course risk management insurance planning, right? This is in terms of how much insurance and how much what type of insurance you need. Then in terms of investment, how to create capital, how to manage capital, how to maximize the returns, right? What do you do in terms of intermediate roles, where do you reinvest in them? Retirement planning to ensure financial independence and retirement. Tax planning, how to get the maximum tax reductions, right? Reduce your tax liabilities, right? And ensuring that you do not end up paying huge amounts of tax, and trying to create knowledge in terms of wherever best you can reduce your tax liabilities. Estate planning is basically how do you manage your assets in terms of your succession planning, that in case how much do you want to leave for your heirs, and ensuring that the tax liability is again the lowest, as well as ensuring that there is no conflicts that after you die, right, all your assets are respectively distributed through all your heirs, and that there is no fighting amongst your heirs, so that everything is clear, right, and try and avoid probate as much as possible. Then cash and liability management is basically in terms of how to maintain liquidity and how much debt you should take, what is the kind of in terms of a good healthy mix of spending and saving, so that you are able to maintain your current lifestyle but also have enough to meet your other financial goals as well. In today's time, like for example, you have a self-regulatory organization for mutual funds, the AMFI. You also have a regulatory body for insurance, which is the IRDA. You have a regulatory body now even for pensions, which is PFRDA. Right? Similarly, we have a regulatory organization for management of financial advisors. It is actually a private-public enterprise, and it's a professional standard setting board. It is a self-regulatory organization which is based on 4 E's, that is on education, examination, ethics, right, and in terms of capability, experience in terms of whatever the charter members are. And they have a system by which you need to revise and get certain amount of credits every 2 years or so that you can continue to practice. But it has its own code of ethics. It has a code of professional capability. It is a self-regulatory organization. It means that whichever members are there through its charter, they are supposed to self-regulate themselves. They have number of partners, which some are leading ones, HDFC, Chola, Deutsche Bank, ICICI, Padmakshi, Fidelity, and so on and so on. Right? So this is in terms of what is financial planning, what are financial planners, what is the subject material of financial planners, who regulates financial planners. This is effectively, how to begin in terms of introduction to financial planning.